If you're going to tweet this morning, please do use the hashtag Churchill Club. And you should find other Twitter codes in your printed programs. Our moderator, Richard Dickson, is a partner in the corporate group at Fenwick and West. He was recently elected incoming chair of the firm, which is certainly a prestigious honor. He assumes that role in January. Richard advises a wide range of high-tech companies, from internet to telecommunications and software to semiconductors. And his practice includes startups, VCs. He deals with intellectual property matters, strategic alliances, M&A, and IPOs. His unusually deep and broad experience and insights make him perfectly suited to lead our discussion this morning. Please welcome Richard Dickson.
Thank you. Pleasure to be here. I'm pleased that you all could join us. Maybe we could just start by Michael and Mumtaz introducing themselves.
Michael has a longer introduction story.
But less to say. My name is Michael Raynor. I'm a director in Deloitte Services. I've been with Deloitte now for about 13 years since I rejoined the firm in 2000. I have an undergraduate in philosophy, an MBA, and a doctorate from the Harvard Business School, and have been in the eminence and research function at Deloitte pretty much nonstop since 2000.
I'm Ahmed. I've been with Deloitte for 30 years, or 30 plus years, in 3 continents, but most recently in San Francisco for the last 13 or 14 years. I run strategy, corporate development, and brand innovation, etc. for the firm. And I also continue to consult, mainly in telecommunications and technology.
Hold it like an ice cream cone. So you're gonna
Okay.
Well, with Karen's introduction, I'm sure everybody out there is wanting to know what are the 3 rules. But before we get there, what constitutes standout performance? Tell us, that was clearly a part of, I think, your research in your book is sort of what are the rules to follow to get there. But where is there? What constitutes standout performance? Tell us a bit about that to start.
Sure. So I guess this research project began many moons ago with a dangerously, deceptively, perhaps simple question, which was precisely that. If you're trying to understand what constitutes great performance, you have to study companies that have delivered great performance. So how good is good enough to be great? And that's something that a lot of research in this space has tended to walk past. So there's a whole genre of business books that we refer to affectionately as success studies that have attempted to look at the drivers of standout performance, and the way they identify their samples is they essentially take a look at all the various publicly traded companies that are out there, and they pick companies that have cleared some benchmark. They've beat the market by 10-fold over 10 years or something. But if you remember your high school statistics, that's just the right tail of the distribution. There's no guarantee that anybody has been good enough for long enough to have any confidence that there's more than just lucky random walks at work here. And so where we started was really trying to wrestle that particular alligator to the ground, and that was a couple of years of effort in close collaboration with a professor in the McCombs Business School at the University of Texas at Austin, a fellow named Andy Henderson. That gave rise to a very particular approach to understanding corporate profitability that allowed us to quantify the confidence that a company was far enough beyond the right tail of the distribution that we knew there was something special going on. And so that foundational question and the answer that came out of that is a large part of what gave us the confidence to continue with the work.
So measured by what? Stockholder returns?
Good question. Hopefully this is working now. Yes. So we chose to look at return on assets. We looked at return on assets because as a measure of what management can influence and do, it appeared to be to us to be the most relevant. Now, there are variations, whether it's return on invested capital, return on equity, etc. They're all lined up quite closely. But it was really what management is able to do with the capital that's employed in the business that appeared to us to be most relevant. And we could have looked at TSR, but then TSR, sifting, sort of separating and parsing between expectations and fundamentals becomes a real issue. So that's what we chose to do. And we looked at return on assets for all U.S. public companies for as long as the data are available in order to do this work.
And curiously enough, when you look at shareholder returns through this lens, right, how something that is statistically unlikely, it turns out that actually, as far as we could tell, no company has ever delivered exceptional shareholder returns. And in some sense, that's kind of comforting, right? It means the capital markets are sufficiently efficient that if somebody's delivering outsized returns over time, people pile into the stock, price goes up, returns go down, there's regression to the mean. It's only when you look at the real economy, right, where things like barriers to entry and inimitable corporate assets and so forth that makes it possible to actually earn what they would call in the business economic profit as opposed to merely accounting profit.
So how was your approach? There's, as you noted, there's a ton out there on how to be successful in business. And a lot of that is quantitative research of, you know, one form or another. And then the outputs from all of that, if you tried to follow it all as a manager, you could twist yourself in knots. So what's different about your approach fundamentally?
I think we're looking at the right phenomena, which is fairly fundamental but quite distinct. So if you take a look at all of the, you know, the vast majority of what's been written on this topic, and you then take a look at the companies that people chose to look at in order to understand what determines standout performance, what we find is whether you look at it from a return on asset basis, whether you look at it from a TSR basis, whether you look at it from a growth basis, that essentially only 8% or so of the companies that are featured in all of this work are actually standout performers. So if you're looking at the wrong thing, it's highly unlikely that you will take away the right inferences as to what determines standout performance, which I think that was at the heart of it.
So we better pretty quickly get to what did you find?
So the three rules, they are these. Ready? Better before cheaper, revenue before cost, and wait for it, there are no other rules.
Oh wait, doesn't that mean you could only come up with 2 rules and you felt 2 wasn't enough? So
Well,
you had to add
rules of
another
good
one?
literature demanded 3, I'm afraid. In short, no. And in fact, it's something I'll invite Mumtaz to elaborate on because he has a good perspective on this, which is that the third rule is, in some sense, the negation of where we started our investigation. So I'll ask you to,
Yeah, sure. In fact, we got to 1 and 2 through 3. And here's what we did. So we went out of our way to be very careful about finding and identifying companies that actually had standout performance. We then compared those companies to others that had statistically significant but different signatures of performance. And we tried to understand essentially what's different between great companies, good companies, and ordinary companies. And when you start to take a look at the evidence, we looked at it all of the usual ways. M&A, do the good ones do more or less? Depends. Diversification, movement into new segments, focused business versus a business in many sectors and adjacencies. When we looked at each of the things that's normally trotted out as the key to great performance, we found extremely mixed evidence, and really nothing systematic that said that great companies do more M&A, definitely get into product extensions, absolutely do geographic expansions, etc. No patterns. And so it was sifting through that we then began to understand maybe we shouldn't be looking at what companies do, but with a view to how they're thinking about these various initiatives. What is the higher purpose that they have in mind? That's what led us to the first 2 rules, better before cheaper and revenue before cost.
So tell us more about those 2 rules.
So each of the first 2 is our take on how exceptional companies essentially address 2 critically defining questions, right? The first question is, how do you create value for customers? If you're not creating value for customers, you haven't got a business, so how do you do that? And fundamentally, there are 2 ways a company can differentiate itself in the marketplace. It can either compete on the basis of price, so you can have the cheapest widget, or you can compete on the basis of non-price dimensions of performance, which, as the title would suggest, is anything that's not price. So value, quality, durability, ease of use, convenience, very long list. And what we found is that companies with exceptional performance competed on non-price dimensions of performance and very rarely, if ever, we're able to deliver exceptional profitability with a price-based competitive position.
So is most competition based on a combination of value and price? And how do you determine whether a company is competing on one versus the other as opposed to somewhere on the spectrum of both?
Yeah, I think we think of it in terms of two extremes, which is basically price and non-price value. But as you said, there's a whole band or zone in the middle, which is in the middle. Right? So you have versions of it. The numbers pan out. The evidence is that for really sustained superior performance, you are you're really at the extreme in terms of a really differentiated position, in terms of the attributes that matter to the customer segments that you serve. In the middle, where you basically strike what you think is the right compromise between price and value in terms of the proposition, can lead to good performance, long-run performance, but rarely does it get you into the top decile of performance often enough to allow you to stand out from the rest. You can make a reasonable living, but you are unlikely to essentially occupy the top drawer for a long time.
And that's actually different from what you would read in kind of classic strategy theory, right? Classic strategy theory says you need to be differentiated. You can be a price-based competitor. You can be a non-price-based competitor. Just whatever you do, don't get caught in the middle. I'm not doing too much violence to the truth here, summarizing 30 years of strategy research in that way. But what we found actually goes in the other direction. It says it actually, non-price-based differentiation is actually a pretty miserable place to be. Extreme non-price differentiation is systematically associated with superior performance, and being in the middle is actually not nearly as bad as you might have thought.
So it probably helped to pull out some specific examples, companies from industries that you've analyzed in this way. They provide examples that show what are some companies that are different places on the spectrum and why.
Yeah, so there's retail is one that we've spent actually a fair bit of time illustrating the ideas with, because it's something a lot of people have a very ready and intuitive grasp of. And so one of the trios of companies, so in the research we look at 9 trios, groups of 3. Right? A miracle worker, which is the extreme, the highest performer, long runner, which has exceptional but lower levels of performance, and then average Joes, which as the name would suggest, average performance, average volatility, average lifespan. And in fashion retail, the miracle worker has been Abercrombie & Fitch since it was reincarnated as a public company in 1996. The long runner, a company called Finish Line, which sells athletic apparel, and the average Joe was Sims, which was a discount fashion retailer, which actually has gone bankrupt. And so when you look at those 3, their competitive positions are probably reasonably intuitive to most of you, right? The notion that Abercrombie & Fitch is not competing on price is pretty obvious when the jeans are $230 a pair and the t-shirts are $35 when you're lucky, right? So that is not a price-based competitive position. They're competing on the customer experience, the brand, the fashion, and so forth. You've got Finish Line with an in-the-middle position. They're not necessarily competing on price, but they're selling others branded apparel, Nike, Adidas, that sort of thing, and trying to create a differentiated position that at least separates them from their most direct competitors, places like Foot Locker, for example. And then you've got Sims, which is basically trying to sell the leftovers almost from the fashion houses. So in that sense, we would look at those 3 and say, this is how we think about their competitive positions, and what do you know, that lines up very directly with their long-run performance over time.
Is there an example you can give from, we're here in Silicon Valley, the technology industry?
Sure. In terms of the different sectors that we looked at, linear technologies, for example. Linear technologies has really been an outstanding performer, and in terms of its position, it's all about non-price value, significant price premiums over a sustained period. Step out, electronics. Again, outstanding performance over a long period of time. And there are others in other industries as well. Whether you take Wrigley, whether you take a Maytag in its earlier life, etc. So just a number right across the board.
Who are the counterparts? Those that are the price-based in the tech space. One of the things I'm trying to understand is, does this apply? Do the rules apply broadly across industries? There's retail, that's an example. You know, technology, some might think technology might be the place where these rules apply the most. It's got to be better, not just cheaper. But you know, who are the examples on the downside there?
Oh, okay. So the counterpart to linear in the long run is a company called Micropack, which is for the most part a supplier to the U.S. Department of Defense. And the average Joe was a company called International Rectifier, which is trying to compete largely through volume-driven at lower cost. But what you see is that that linear is able to command the price premium as a consequence on focusing on very small, a very large number of relatively small accounts. And so as a consequence, its products feature prominently in its customers' products in terms of driving their differentiation in the marketplace, which makes them very valuable, but they tend to be a relatively small percentage of the total cost. And so when you're a small percentage of your customer's total cost, but a big part of what makes them special in their markets, you get to turn up the volume on price. Curiously, in other examples, even just within our trio, that doesn't mean, by the way, right, and this speaks to the third rule, that doesn't mean that what you should do is have lots of really small accounts, because we have other miracle workers that have very few accounts that they service very closely and focus very strongly on. So again, we can't say anything about what the structure of your account base should be. All we can tell you is better before cheaper seems to drive both of those companies in very different industries at very different points in time. Perhaps the last thing worth noting around this question of generalizability and does it apply, the research is based on more than 25,000 companies over about 45 years of data, 1966 through 2010, and we're able to identify the full population of every company that ever met our criteria for exceptional performance. So this is no longer a sample drawn from it is the population. And so that gives us a basis for generalization that a lot of work simply can't claim.
Okay, so how is Rule 2 different?
Well, Rule 2 speaks to how you capture value. Right? Rule 1 is how you create value for your customers. Rule 2 is how you capture value for yourself in the form of profits. And there, the way we think about it is that the mathematics of profit are very straightforward. Right? Profit is revenue minus cost. And if you increase revenue by 1 unit or decrease cost by 1 unit, profit responds the same way. But in the world, it turns out that it actually matters a great deal which of those two levers you pull. And the companies that deliver exceptional performance systematically pull the revenue lever rather than pulling the cost lever.
Just to elaborate on that, so you know, when you're looking at performance, you can get to performance by just utilizing your assets a lot better. You can get to performance by managing your costs a lot better. You can get to performance through margin management. So when you look at all of that, it could be any of those things, but it's really about margin management. And in margin management, it's less about the cost of goods sold, for lack of a better word, and it's really about the top line. And in the top line, 3 times out of 4, it's about premium pricing permitted by your differentiated position based on non-price value that really appears to captivate.
So that's what I'm trying to get at is, because I think to restate what you just said is, if you have better, first rule, it enables you to pull the revenue lever, you know, and you can concentrate on revenue. If you don't have better, you're going for cheaper, and so it focuses you on the cost side of the equation. So can we pull those apart a little bit? What's fundamentally different as opposed to the two, one leading you to the other?
Right. Well, if you focus on cheaper, you don't necessarily have to be lower cost in order to have higher profit, because cheaper might drive volume, volume drive turns, turns drives profitability. Right. So in that sense, you don't have to be cheaper on the margin side.
Are you able to give examples in
Well,
companies
no, nobody does it, right? But it's like, the point is, it's logically possible. It could have turned out that way, but it doesn't. You don't see that.
Are there companies that follow one rule and are terrible at the other? In other words, to see that there's 2 different rules here would be helpful to see that
No,
the
absolutely.
exceptional companies are following both. Really bad companies follow neither. But there's a bunch of companies that sometimes follow one and sometimes follow the other. Can we give some examples where that's the case?
Absolutely. So, for example, companies that do really well, but in fact rely on asset utilization, even though their products are all about differentiated positions, would be Merck. So they actually made their superior profitability by really pumping volume and going to several different markets. And in each of those markets, they may not have made the same margins as they made in their core market, but they were price leaders in each market. And through unitizing their intellectual property, they were able to get asset utilization and volume up to such an extent that they're ready to do that. If you were to take a look at linear technology, for example, we talked about that. No, I don't think it got any more than 3% of its sales from any sector. But one of its analog processors, for example, essentially is used for power management in cell phones, smartphones, etc. The ability to extend battery life and the price premiums they were able to charge as a consequence of that was all about price premiums. So it takes different forms and people pull different levers, but it can be both of those things.
And I guess the last thing is companies, to show that the rules are not monotonically related, right? One does not necessarily imply the other. We've got companies in the sample where they not only attempt to build, but in fact create highly differentiated positions, but are unable to pull the revenue lever in a way that delivers superior profitability. So if you look at Whole Foods, nobody would be, I don't think I'd get much pushback if I said Whole Foods is pushing for a non-price position in the marketplace, right? They have a highly differentiated position, they have unique products in many ways, high levels of service, very nice fixtures and fittings in terms of their stores, right? So, right, everybody's on board. Okay. You wouldn't walk into a Whole Foods and think you'd taken a wrong turn and walk into a discount store. You know what they're all about, and they know what they're all about, to their credit. However, their profitability up through about 2010 was effectively that of an average Joe. They had average levels of profitability. And what that meant is they were fundamentally unable to strike the right balance. They weren't able to create enough value at sufficiently low cost that even at the prices they charged, they were able to deliver superior profits. Now that's been changing of late. You look at their performance over the last 4 or 5 years, and it looks as though they're starting to kind of sort that out. And so their profitability has been increasing over time as they strike the right balance between the value they provide and the value they capture.
I think you sold the entire room on Whole Foods. It's focused on better versus cheaper. Not too much dispute there. So what is it that you think they might be doing? I mean, if you can give an example of how they're not following rule number 2.
Well, no, but that's simply a function of what their profits look like, right? So when you look at their performance, it is unexceptional, and it is a consequence of the fact that they have they're unable to generate either the volume or the gross margins to deliver high profit, superior profitability.
So it's not necessarily the case that they're not exceptional because they're failing to follow rule 2.
No, well,
if you force me to make a choice, I'd say they've got rule 1 down pat, but they're simply not able to capture the value that they need, which is really what rule 2 is about. And somewhere in their monetization of what is otherwise a great differentiated position, they're falling short, or they have, over a period of time, fallen short.
So I'm a manager. What's your advice for managers of companies on how to follow these rules? Why doesn't why doesn't everybody follow them?
well, first buy the book. That would be my first piece of I think it's largely about understanding your relative competitive position. I think that's where most people fall down. Is that when they look at how they are progressing over time, managers in many companies I've seen, they tend to compare themselves to themselves. So they look at how their product is improved, and they say, our product this year is twice as good as what it was last year. I have bad news for you. You don't compete with yourself from last year. You compete with what the other guy is selling today. And people look at their costs, and they say, our costs are lower than they were last. So what? The only thing that matters is what is your relative competitive position and relative revenue position compared to the relevant competition today. Now, forgive me if that sounds obvious, but based on my relatively limited experience, I would say that is something that people routinely forget. And that understanding that in a way that drives the choices you make is something that a lot of people just don't do. And so that's a big part of the reason why they don't follow the rules. I don't know, what would you think?
I agree with you.
I just think, Richard, that there's just a lack of a strategic coherence, especially in companies of any size and scale and scope. The ability to focus on the few things that matter. I'm trying to wean our own firm of, we're the largest professional services firm in the U.S. I'm trying to wean our own firm of the growth. That growth is everything. It's an outcome as far as I'm concerned, as opposed to the objective. Right. So, just to get people to focus on the few things that matter and look in relation to the competition, as opposed to thinking really only about the top line and only in relation to yourself in the past, I think those would be important things. So it's the relative price-value proposition that's everything as far as we're concerned.
And then I guess the last piece of it is that, I think it was Samuel Johnson said people benefit more often from being reminded than from being instructed. And very often when it comes to running companies, we kind of feel in our tummies that competing on the basis of value is better. Driving, you can't cut your way to greatness. That's been around for a long time. But when it comes right up against it and people are forced to make the many choices that they make every day in the face of the various temptations and distractions and pressures that they face, shockingly, it's easier to do the easier thing. And so, to some extent, our hope is what the research does is provide people with the courage and the confidence to actually make the hard choices and stick with better and revenue.
Yeah, well, Mumtaz, you said something that was interesting there in the context of your own organization, because Rule 2 says revenue, not cost. Some might interpret revenue as grow it.
Yes.
You said no growth for the sake of growth.
Right.
So how do I reconcile those?
So what I'm really trying to make the distinction is between indiscriminate growth and growth rooted and based on great position.
Make sure.
Right. So I think that's critical because the fashion has been to grow larger, add more adjacencies. We can also do this. We can also add on this. I do forensics, why can't I do X? And so you continue to build out the footprint and you get very large. But are you perceived as the class act in each of the markets that you perform in is an entirely separate proposition. And for me, it's about that positioning and growth that is an outcome of that positioning. It's the quality of growth that I think really matters.
Don't be driven by one rule without making sure you're following the other.
Absolutely. In fact, that's why it's Rule 2 rather than Rule 1. Start with positioning, and then good things should follow as long as you can capture value now that you've created.
So I think the application examples are really helpful. There may be some in the audience that are saying, well, we looked historically at a bunch of companies, those that were successful by whatever measure, in this case, return on assets and so forth. You might expect successful companies to grow revenue. You might expect unsuccessful companies to reduce costs. They're forced into that situation. They're not being very successful. How's the correlation causation piece work here?
I'll give it a shot. I mean, certainly all great firms have been growth firms, but the vast majority of growth firms are not great firms. And that's this issue around indiscriminate growth. I think that's really important. The second thing is that great firms, standout performers, are rarely the best cost managers. In fact, on most benchmarks, you will find that they don't do well. Here's the pattern you'll see. Very significant gross margin differentials and advantages over the competition, and ceding quite a lot of ground on other costs, SG&A, R&D, etc. But the net effect is to have a differential in terms of return on sales, and then asset turnover that gives them that standout performance.
Are there examples we can use to help illustrate that? Because when we gave examples earlier, I saw lots of heads nodding in the audience, and that helps with the. Can you illustrate some examples of that?
So, sure. And I'll give you an example that might be somewhat counterintuitive. So if you look at the discount retail space, if ever there were an industry where you thought that sort of competing on price was going to be the key to success, you'd think it would be discount retail. And it turns out that the miracle worker in discount retail is Family Dollar. and you look at some of the leaders in the discount space, and they are on the order of 100 times bigger in terms of revenue. So this notion of, now that's not to say that, the company that I'm comparing them to here is a long runner, so they have their own form of exceptional growth, but they're not the miracle worker. Family Dollar was the miracle worker with 2 orders of magnitude less in total revenue over a 30-year period, and yet profitability that was running 2 percentage points of ROA on average better over a 3-decade period. And the way that worked is that this company had lower asset turns, higher SG&A, but massively higher gross margins as a consequence of its ability to effectively break bulk profitably in the discount end of the spectrum. So it runs now we're not talking a 30 or 40 or 50% price premium here, right? I'm not comparing Bergdorf's with Target or anything silly, right? I'm comparing companies that customers would view as close substitutes. And so we're looking at a price premium of 4, 5, 6%. But in the discount retail space, where you would expect markets to be enormously price sensitive. So even in discount retail, you see a differentiated position based on small stores in convenient locations commanding a price premium that results in superior profitability, but one that has put constraints on their ability to grow, but one that they have been willing to accept.
That same price premium, for example, the example of Abercrombie & Fitch, and if you were to take a look at Gap, others, that same price premium in a different sector would be something like 30 to 40%. That's what they command in high-end retail, for example, in retail apparel.
Are there others besides managers that can take advantage of these rules? How would investors take advantage of these rules? Can they?
I got that question on a news magazine show back home in Toronto, and I kind of chuckled and said, if I could pick stocks, I wouldn't have to work for a living. So the short answer is maybe. There's no question, but there's a connection between profitability and shareholder return. Everybody feeds from the profit trough eventually, right? Unless you subscribe to the greater fool theory of investing, ultimately it's got to show up in cash. And when we look at the relationship, the companies that have superior profitability by our lights tend to do significantly better than average with respect to shareholder returns. That statement does not apply in the other direction, right? You pick companies that have great shareholder returns over randomly selected periods of time. They don't necessarily have superior profits. So the connection to value creation is certainly there, but it's not there in a way that allows us to say, oh, well, that one's a buy and that one's a sell. Certainly not over a specifiable period of time.
Just finally, test that third rule a little bit. Are you saying that there's nothing else that correlated with exceptional performance?
We reserve the right to learn, just like everybody else. So, show me new data, we'll change our opinion. But for now, those are the only 2 things that seem systematically related. I mean, I've written 2 books on innovation, and it broke my heart to have to give up the notion that innovation was something other than a defining feature of exceptional performers. It's not. Sometimes innovation is central to what they do and how they drive their performance. So and in the tech and medical sciences sector in particular, Medtronic, Merck, linear technology. In other sectors, effectively irrelevant. Long haul trucking, discount retail doesn't seem to matter. There, it's not so much about breaking trade-offs, which is how we think about what an innovation actually is. There, it seems to be much more about embracing trade-offs, accepting the fact that to get this, you have to give that. So there were a lot of things that we really wanted to see being fundamental drivers, and they simply weren't there. So culture, leadership, innovation, as I mentioned, Mumtaz talked about geographic expansion and M&A, nothing. We were kind of left with this. I remember at one point I said, I've got it. When it comes to M&A, you'll agree with this. The key is to do the right deal with the right counterparty at the right time in the right way. Then you think, well, that's not particularly helpful. And the first 2 rules clear that bar, right? Better before cheaper. It could have turned out the other way, right? We could have found out it was cheaper before better, but it's not. We could have found out it's cost before revenue, but it's not. And that actually is a big difference from a lot of what I think you've seen in other works. You look at some of the success study books, and they'll tell you things like you should get the right people on the bus. Right. So anybody out there deliberately trying to put the wrong people on the bus? You get things like have a clear and focused strategy. Oh, good. I was trying to write an unclear and unfocused. I'm glad you see my point. Right? So the substance of the rules is such that they provide real advice. When you come to that fork in the road and you're faced with a choice, do I stay the course and compete on better? Do I give it up and compete on price? That can be an ambiguous situation, and that's when the rules prove helpful.
So now that you spent all this time, studying all these companies, and now when you look at a company, and maybe you have some examples of this, you see they're not following rule number 1, they're not following rule number 2. I mean, given where they're positioned at, where you see specific decisions, I think you start to see them in that light. Do you have some favorite examples of, things that you've sort of noted that are happening out there that you tend to question based on your research?
I would turn that around a little bit, Richard, and say, if there is a leading indicator, I'd like to see what companies are doing with pricing power in their markets. And that applies to any markets. It's whether it's industrial alcohol, whether they're purveyors of industrial alcohol, or the latest widget, or the latest smartphone, etc. If I can start, if all that they're doing, if all of the initiatives are starting to trickle into pricing power, of all of the crude leading indicators that I can think of, that's the one that I would be focused on to try and understand whether they're doing things that can sustain that and improve that over a period of time. To me, that would be the best indication of whether the company's on the right track.
Any come to mind for you?
I guess the one thing I'd say is that the conversations that I get with people is that has really illustrated to me so far at least how tricky it can be to apply this, right? So they're easy to state, you can put them on a bumper sticker, but getting it right is often hard, and it speaks to what is the relevant competition and what comparisons you make. So people have said to me, oh geez, so Apple's coming out with the iPad mini, clearly they've lost their way, they're not following the rules. I don't know about that. What is the competition for the iPad mini, and how is it priced compared to the competition? So the fact that the iPad mini is cheaper than the iPad does not mean that they're abandoning Rule 2. Right? It means that the market is fragmenting and segmenting, and compared to the relevant competition, now we have to have another conversation. So it is not, I think the rules are substantive, I think they can be helpful, I think they can point in the right direction that companies need to move over time. And the more I've worked with them, the more I've realized that it's hard to apply them accurately and well. Would that it were simple, but if these things were easy, we'd all be rich, right?
Well, I think it's about time for me to stop asking all the questions and let some others participate so that we can find out what questions I really should have been asking. One headed towards the back there.
Hello, my name is Doug Andre, and I just had a question. Did your study just study purely American companies?
We looked, the work that we've done, the data is a global database, and it extends right across. But from the point of view of just looking, being able to do the case studies, etc., we focus those on U.S. public companies.
Okay, well, the question I had is Samsung. And like Samsung went through 3 different stages of, your 3 questions. Initially, Samsung was market share driven in cell phones. They were also the lowest cost, but they really didn't care about premium pricing. But whereas you telescope it to today, they're very much concerned about, having high-end phones. And in fact, their high-end phones, with the exception of the United States, outsell Apple 2 to 1. But at the same time, if you look at their bill of materials for being, what goes into their high-end phones, they're far lower cost than Apple because they're sourcing things internally. So also within their low-end product line, they also, still focus on gaining market share, but their top-line revenue is growing far faster than Apple right now. Can a company, depending on their product line, follow 3 separate sets of rules, depending where they are, and still be a very successful company?
I think it's a I think it's a tough balancing act. Because, I mean, when you're down to it, it's talking about separating operating models and strategy models between different parts of the business. But I think if you're big enough and you create the structures in order to be able to do that, I think it should be possible to do so. Another company that's attempting that from the same country, of course, is Hyundai. They're moving up market now, having done the volume play for quite some time. So there are examples of that, but it requires separation of just operating models, and more people sort of fail at that and succeed, would be my reaction. But nothing to stop that from happening.
The only other thing I'd add is I don't know right now whether Samsung has exceptional profitability or not, right? So you can look at companies that have behaviors that are consistent or inconsistent with what we might prescribe, but until we're able to say, well, they've delivered outsized performance, yes or no, we can't say anything about the relationship between the strategic choices they've made and how that has driven profitability over time. So I just don't know, and I don't know the answer to that question.
Electronic company in the world in terms of percentage of sales.
I'm sorry, say that again?
They're the second most profitable company in the electronics industry outside of Apple as a percentage of sales.
Let's go to the next.
Okay, but that actually may not matter, right? Because what we're looking at is relative profitability, correcting for things like size, industry effect, survivor bias, country of origin, right? We want the relative profitability, not the absolute profitability. So in percentage points, they may have the highest and second highest number. In terms of relative position, we have to do the math before we know whether or not they've delivered that outsized performance.
Let's go to the next question here.
Is it on? Thank you. This relates to the question of innovation. I'd like to take you back to Whole Foods. If you look at the intangibles in a situation, which I know is very difficult the way you have structured your study, if you compare Whole Foods with a very small chain in the East called Wegmans, I don't know if you've looked, they're private, and already some people are shaking their heads because they recognize the name. Wegmans outstrips Whole Foods by a factor, I'd say, 10 to 1.
With respect to what?
In terms of innovation, in terms of how they have developed their brands and how they've used their brands. Whole Foods doesn't seem to even carry a candle to what Wegmans does on a daily basis. Now, this is a level of innovation that I think you can't capture in your study, but I think can be very, very important in terms of the success of a public corporation. If Wegmans were a public corporation and the figures are out, I would say you would find maybe some exceptions to your rules. For instance, what they have done is to build a reputation and then use that reputation to have private brands. In fact, they even have a private brand of toilet paper that they sell by the tons there. Whole Foods has some private brands, but their private brands don't have the cachet, even with the good name of Whole Foods that you have there. There are a number of other intangibles involved with this too. So how do you capture this spirit of innovation that you've talked about that allows Whole Foods to compete with an organization like that?
Can you say more about why Wegmans is in any way an exception?
Well, the number of things that they do, they have an unusual personnel policies that go with it. They give scholarships. They have an unusual cadre of people who come.
But none of those things are exceptions, right? I mean, what I hear you describing are the specific mechanisms that allow Wegmans. So let's just we'll grant your premise, which is that Wegmans is an exceptional performer.
Yeah.
And what I hear you describing are the ways in which Wegmans does this.
Yeah.
And since that's not something that applies to pharmaceuticals or trucking or discount retail, I can't make rules out of those things.
All right.
There are no other rules. Those are the specific levers they pull in that industry today to, guess what, be better before cheaper and revenue before cost.
Right,
so it seems to me that's an example of the application of the rules.
And so, similarly, when we looked at Heartland Express, when we looked at Heartland Express, which is basically a truckload trucker, it did quite a sensational job of human resources management and funding scholarships for its drivers' children,
Right.
etc., was all part of a move to essentially attract the best drivers in the industry to them, because on time and deliveries, quality, reliability was what allowed them to earn the price premium. So what they did with their drivers and the scholarships was simply a way to allow them to be better before cheaper.
Okay.
Many companies will use different mechanisms, but they're all in the service of one of these two rules. That would be our point.
Okay, that answers my question. Thank you very much.
Next question.
Thank you. I'd like to bring up a Southwest, which basically seems like was more price before quality, and they've changed recently. You know, they've offered like free bags and things like that, but in the past it was just pure price.
And not a miracle worker. So they're not exceptionally profitable.
But I thought they were the most profitable airline over a period of time.
Sure, but that's the best of a bad lot last time I checked. So they're just not exceptionally profitable. And it's perfect, you can make a living, right? But it's systematically not the way to deliver outsized profits over time.
So when you take a look at Southwest, I remember there was a time that Southwest's market capitalization was greater than the market capitalization of all other airlines in the US, etc. That's all fine. But when you take a look at their performance, just for the industry sector, size, and a whole bunch of other things, their ROA, their return on assets, in relation to the whole competitive market, was not significantly better. So they may have been 7th decile performers or 8th decile performers. When we talk about about miracle workers, we're talking over 45 years of U.S. public company history of about 150 companies. You can imagine how many thousands that were able to deliver top decile performances in enough years that there was no ambiguity about the fact that they had done something different. So not only top decile performance, but enough of them given the lifespan of the company. In that context, Southwest, interesting, memorable, often trotted out, iconic, but not a miracle worker in the way we think about it.
Great, thank you. I have a second question as well. It's about China. So China has been mostly a price leader. So would you say that China is, just as a country with all the companies, is not a top performer in any of the segments?
I would say, first of all, when you're looking at China, we're looking, first of all, at a different economic system, different capital markets, etc., dominated by state-owned enterprises, and just how that works, whether it's in China or whether it's regional banks in Germany, it's quite different from the system that we have in here. We're looking at companies that are exceptional, and so I gave you the example of 150 companies in the US over the last 30 or 40 years have been exceptional. All over the world, you could say, you can double that number and say there are 300 companies. Right? China may have one or two, I can't cite them offhand, but it's not, I can't think of companies, many, that would rank with what we found in the US competitive system.
I guess the only thing to underline is that no measure of performance measures everything that matters, right? We looked at profitability. If you think profitability is a measure that matters, we have something to say about how you can drive exceptional profitability over time. There may be other things that are important too in other contexts, and there will be other rules you need to follow in order to drive those measures of performance. So it's this will shock you, enthusiastic about what we think we found, but we're circumspect about this is not a theory of everything. It is a theory of how to drive superior profitability over the long haul.
Next question.
I'm just wondering if you have any advice for late-stage startups who would love to go IPO. However, the pragmatic reality is that growth and hyper-growth and profitability are, their measures are so different, and they drive internal dynamics in companies that I actually think at this point in time, no company wants to go public. They want to be bought. Average. Obviously there's the exceptions. But it just, VCs have the same requirement. They're just put huge pressure on the internal dynamics of a company that create behaviors that are completely counter to what you're saying before they even get established, get their roots in the ground. So I'm just curious how you've been looking at companies that have made it, but the problem is how do companies get to make it and still live by these rules?
Well, it's interesting because we've talked about companies that made it. In fact, we categorize these really exceptional performers, what we call miracle workers. There are three categories of those. Those that have always been there since they've been around. Those that found their groove, and those that lost it. And what's interesting we found is that for those who found it, they moved towards non-price positions and revenue before cost, etc. Those that lost their groove, went the other way. All I'd say to you is there are all kinds of accommodations that you have to make in the short to medium term. But in the long haul, the compass that drives your behavior, yes, you have to accommodate investor expectations. Yes, you have to cut costs at certain times. Yes, you may have to concede on price on certain times. But if the compass is about positioning for the long haul, I don't think we see companies that are always top decile performers, Abercrombie and Fitch, in a number of lean years. But interestingly enough, it shows under extreme market pressure not to discount. And it was it was condemned for it by the investor community, etc., and only to sort of find vindication when the market started to turn again, and it held on to its pricing power. And I think you've got to be able to just look beyond the trough and stick with these two guiding principles.
I'm Rebecca Rounds, Lighthouse Information Systems. My question is about Ron Johnson and J.C. Penney and his gambit to move towards revenue over cost and all of these things, and how all that went for him, and what your comments would be on that.
Well, I won't comment on the specifics because I'm not in the know, but in general, this is a necessary but not sufficient situation we're dealing with. You've got to be able to strive for it, but other pieces have to fall into place in order to be able to execute. You've got to be able to execute it. We will never know, but in principle, the notion of finding higher ground in terms of positioning in different segments, if you're in, holds more. To us, the evidence is that it holds more promise than the contrary.
I suppose I'd go out on a little bit on a limb and purely as a hypothetical suggest that the question becomes whether the positioning, forgive me for repeating myself, compared to the relevant competition made sense. So if you're going to go to a store within a store concept, do you end up as a much better Target or just a really lousy Macy's? And that's a hard problem to solve, right? And I don't know the answer to that question. And I'm also open to the possibility, by the way, that there are exceptions to the rules, right? These are 3 rules, not 3 laws of physics. We have examples among the 27 case studies we looked at where companies were price and cost leaders and delivered exceptional performance as a consequence. You can be an exceptional performer based on price-based competition. That's just not the grain of the wood.
So out of the 9 that we looked at, one was, and as it happens, it's Wise Supermarkets in Pennsylvania that was able to do that. It was it led with private label before anybody else did, etc. But that would be by far and away a minority. The evidence is the contrary.
You've got another question?
Hi there, my name is Geraldine Prazoon. I just had one question. I was wondering whether you have actually talked to some of the miracle workers from your study and found out whether over those 40, 50 years they had actually a management focus on extracting that kind of price premium. Because I imagine, it's one thing to say, okay, these companies have actually been able to increase the willingness to pay. They've actually, through a bunch of techniques, extracted that price premium versus the competition. But from a manager's perspective, I would say, it's the question is how much of that, in your Harvard Business Review article, you said you wanted to look at, what is luck and what isn't luck. How much of this positioning sort of happened, accidentally. Someone, hit the nerve of time and then hit it again because someone else got hired. Have you gotten some feedback? Have these companies actually focused on extracting the premium over a long period of time?
I'll start by just telling you how that first HBR article got us into trouble. I think it was called "Are You Great or Are You Lucky?" And then we wrote off to one of our medical workers and said, this is the work we're doing. We'd like to come and talk to you about this. Can you meet with us? And the guy says, if you just think I'm lucky, why the hell would I talk to you about this? So that was the end of that case study. So, I didn't have the time to sort of give him the nuanced argument about, we couldn't be statistically sure, etc. Anyway, but the point is that, yes, we did. We talked to people, and we talked to, Merck. At Merck, we talked to 3 generations of CEOs. Roy Vagelos being the one that was there from 1975 to 1995, first as head of R&D and then as CEO. And I think in many of these cases there is in this case, for example, an unerring instinct to just get the right solution, the best solution. And they were able to do it by basically, their holy trinity was, their labs, the National Institute of Health, and academia, and they were able to, attract the very best as they made their migration from chemistry to biology, etc. So they had a very clear idea, or he had a very clear idea as to where he was going to go with this. As it happens, the idea as to how it got monetized was a little murkier, which is an interesting observation that we came up with. In that, if you asked him what made you successful financially, I think the answer was a little less clear. But in terms of positioning, there was very little ambiguity.
No, I think that's right. In those instances where we're able to talk to the folks who were running these companies, the better before cheaper piece was very deliberate, right? Hard to have a successful non-price position in the marketplace accidentally, right? So that part they did very, very purposefully and very deliberately. How it gets turned into profits is something that, as Mumtaz said, is something that not everyone had as clear a line of sight to in terms of what was really driving profitability over time. And I guess what that points to, at least in my mind, is the fact that the 3 rules don't answer all your questions, right? If we say better before cheaper, it's not unreasonable to say, okay, smart guys, so how am I supposed to be better today in this industry against these competitors with these customers? That's the right question to ask, and it's not in the book, right? I mean, this compass metaphor is kind of the best we can do, right? Of all the hard problems you could try and solve, right, the better problem, the cheaper problem, solve the better problem. Of the revenue problem or the cost problem, solve the revenue problem. Now, precisely what constitutes a solution, that's why we play the game. But the hope is that at a minimum, what the book does is identify the right questions to ask.
Michael, Mumtaz, thank you very much for sharing the results of your research and helping us think about how to apply it a bit. And Karen, you've got a couple of closing remarks.
Michael and Mumtaz, thank you so much for sharing your perspectives so freely. This has really been a valuable conversation, yes? And Richard for leading the discussion so magnificently. A copy of the 3 rules is available as a courtesy for your purchase. And will the authors be able to stick around for a bit to sign the personalized copies?
Absolutely, we'll sign as many as they buy.
That's great. Thanks again to Fenwick. A copy of this recording will be available on our YouTube channel probably in about 4 days. Usually it's 2, but this time it will take a little bit longer. And you have been a wonderful audience. Thank you so much. We'll see you next time.
We all rely on it.
It's a good app. I know a lot of people use that one too. Sweet Deck.
It's similar.
It's got all these different.
But it's for this it's really great.
Wi-Fi connection is service.
Were you able to log on to the light? Yeah.
That's easy.
It's nice that it's free.
I know. Hotel especially really charge you.
It's on budget, but sometimes you don't do it. It's not worth $30 for one day.
Right. Yeah, for them, it's too much.
And one day too, it's gonna be free everywhere.
Right.
And it's unbelievable that it's not. Establish a really good Wi-Fi connection for extremely cheap.
Yeah, it's Google used to have a downgrade, but that
Established a Wi-Fi system to the city. It's so slow. It's so bad. Not really sure everyone has their theories, but they're trying out to use Wi-Fi because they're not wrong for it. So until that happens, very, very easy.